In this video, I want to show you why I believe Tesla will be breaking all-time new highs within the next, I'm going to say 1 month, okay, by the first week in May. Now let's go through and analyze this market, and I'll show you why I'm making that prediction. It's a pretty bold prediction, right? So let's go ahead and analyze this market, and I'll show you why. The first thing we're looking at here is I just want to identify for you, this is drive 1 and this is drive 2 of a new Elliott wave, okay? We need drive 3. So we got this major pullback as the entire market pulled back and had a big long pullback and a reset, right? So as we come in here and we just draw our Fibonacci ruler in there, we can see that this market came right down and pounded, broke right off at the 61.8 and started to rally once again. Came down and tested that 61.8 one more time, used it as support, starts to rally once again, and this gives us confidence because now we have higher lows and we're looking for higher highs. All we need to do is break above this previous high right in here at 38.2, as you can see, just above 38.2, and we'll have higher highs. So higher lows and higher highs makes the definition of an uptrend, and that's why we're anticipating a continuation, a rise in Tesla, as along with the many other markets are also rising as well. So let's come in here with our Fibonacci projection tool, and I'm just going to take the Fibonacci projection tool, the 1, 2, 3 tool. We're going to go off this low, 379.11, and we're going to go all the way up to the high, which is 940. We're going to come back to this low here, which you can see is a 69.4% retracement, and the price level, of course, is 536.78, and we're going to set that. Now, once we set that, we're anticipating, or this is our next projection. This is a Fibonacci projection of where we think this market's going to go based on the reflection of the previous trend, okay? It's the A, B, C, D position. So now where are we going to go to? Where are we going to anticipate? Well, we're going to anticipate that we're going to break this high right here at this point right there. Now on price and time. If this model stays in the same trajectory or in the same volatility scale as it's been over the last 3 months, this is where we'd anticipate this market making it to. Now it might go a little faster, it might go a little slower, but we are anticipating right out here somewhere. This is our actual target goal for Tesla to make all-time new highs. All right, so that's our goal, which of course, if you look at that, that crosses over right at May 3rd. So that first week in May is when we're going to anticipate that Tesla is going to be right back up here if it maintains that same trajectory, okay, or that same volatility scale. Now, could it go higher? Yeah, of course, it could go higher. 100 is right up here, and that says May 26th. So by the end of May, we could see it up around the 100 level, which would be a complete reflection of the previous drive, the 2-drive pattern, right? Now, we might actually even get a 3-drive pattern on our way up. We don't know, right? We're swagging here. We're a scientific wild-ass guess, but we want to be as scientific about our wild-ass guesses as we possibly can. And so this is where we're going to anticipate and look for this market to go. So how are we going to play this? What are we going to do? Let's come in here and take a little bit closer look. I'm going to come in with our spider web, okay, and we're going to go off this peak right up in here. And you can see the natural trend line coming in right across those red bars, okay? So I'm going to put my first spider web right there. Now the second spider web, I could put right at the green, or the blue lights, cross over the blue lights. But there's a second spider web right there that comes across the top of that first yellow bar. That's our dip trade, right? So if you're familiar with the dip trade strategy, that would be our first dip trade. Now we could go off of the breaking of the trend line, which was the first bar. The second one is a confirmation of the breaking of the trend line, which would be the first yellow bar. And then, of course, breaking of the blue lights. That we're going to put in there the third spider web. And then the fourth spider web, the final one, is a horizontal break across that high point or that high peak. So we got 3 spider webs in there, 3 different locations for entry into this market. Now, the other thing that I want to bring to your attention, it's very important to see that green line in there. That green line is the moving average, and I've got it set to 16. And the reason I tuned it in to 16 is because that's where it crosses and follows along with the blue lights as closely as possible. I like to see the green line and the blue lights cross like right there. See how beautiful that is? That's a perfect setup. So I tuned in the green line, or this is just a simple moving average, to cross over the same places as some of these crossovers of the blue lights. I like them to be right on top of each other. This is not exactly, but it's right there, right? So what we're going to use is we're going to do this as a long position. We're going to anticipate a long position. Now, there's a number of ways you could do this. You come in here and you could, of course, come in and put a chicken wing in here if that's the way you'd like to do it. You could also come in here and buy some shares if that's the way you would like to do it. Or just buy a call option. Let's go ahead and we could just buy a call option. And if we buy a call option, we're going to come down here and price one out. We have to determine how long, how much time we need. Now, how much time we need is probably double of where we think the target's going to go. That's what we always say, right? If it's going to be 30 days away, we want at least 60 days. But if we have this goal of 100 in here, if we think it might actually even go higher than the previous high, and we want an anticipation, we can give ourselves a little bit more. And of course, the golden ratio would be up there at 130.9. Now, wouldn't that be sweet? That would probably be a complete, to get there, it'd probably take a full three drive pattern through the Elliott wave, that whole A section, a B section, and or A section, B section, and C section to get all the way up there. But nonetheless, that would be an ultimate goal for Tesla, right? And if it did that, let's come in here with a single option. If we just bought one option, we grab our dollar calculator from where it's currently trading up to the 100% level, that would be a $35,000, almost a $36,000 move. Up to 130.9 would be a $50,000 move for a single call option. That would be 100 shares, all right? So 100 shares would take you all the way to $50,000. Now, what can we buy one option for? Let's come down here and take a look. Now, I've got this set to 100 days. Now, again, if we come in here with our bar calculator and we go out there, that's about 53 days to the 130% level. So if we double that, we want to be out right around 100 days. So that's why we like to go out a long ways, double the amount of time of where we anticipate based on the Fibonacci projection of where we think this market's going to be in price and time at the ultimate level, right? And then double that time. Now we're going to come out here and that's about 100 days. So that gives us a call option. A 700 call is $8,832. So if we take again our dollar calculator, we're going to basically estimate or say that if it goes from here to here, that would be a $50,000 move for an $8,000 investment. So that's a pretty good risk versus reward ratio. All right, so we like that. So let's come in here and let's come in and say we're going to buy that. So let's say we're going to buy that call option. And it's basically right at the money, right? So it's right at the money. Now, what if we're wrong? All right, rarely happens, right? But what if we are wrong? Rarely happens. We know that we can be wrong. Okay, so where is our ripcord or pull this thing out if we're wrong? It would be that green line. Okay, that would be our stop on this order, on this this call option. Okay, so this is going to move, of course, and so is the market. And if the market crosses over that green line at this point, we're going to get out. We're going to take our lumps and get out, and we're going to lose a little bit, but we're not going to risk that full $8,000. No way. All right, we're just going to risk if the market falls below that green line, that's where we'll get out. Now, if that's the case, if it stays above the green line, let's say it goes above the green line and goes up in here at 50%, it starts to pull back at this point, and then drops below the green line up here. Now, we would be in a profitable state, or we should be at that point, be in a profitable state, and it falls below the green line up there. Do you want to take the option, take your profit off at the green line? Yeah, that would be a good place to take some profits, and you could always buy it back in if it crosses back above the green line, or we get a new A, B, C section in here and a new setup and based on our Fibonacci and Elliott Wave strategies, right? Our count, measure, setup, trigger, follow through. So that would be kind of the way that we're going to watch this particular option and get out if we're wrong when it crosses the green line. Now, of course, right here is the most important time frame. If this thing turns around and starts to just cascade against us immediately tomorrow after we buy it on the close of business today, we want to immediately just get out and cut our losses if it breaks below that green line tomorrow. But if it stays above the green line tomorrow and continues to rally like we hope on the open, then this is where we would start to look for that green line to start to follow up and trail us behind this market. So we don't want to take a big risk. That's the whole idea, right? We want to cut our losers short and let our winners run. Now, if we come in here and just draw our arrow from where we're currently in the market to expiration, and we have to come up here and identify where the break-even point is. Now, that would be about $8,700. So we have to go up $8,700, which would be about right there. And I'm going to draw a horizontal line at $8,700, and I'm going to bring my arrow, my trajectory arrow, right to that point. So that means that Tesla would have to gain above that white line to stay profitable all the way to that purple line. If it falls below that white line, we're going to show a loss on the trade. As long as it stays above that white line, and of course that white line's not, that's just a straight white line, and we know that the theta actually has more of a curve to it. But that's a pretty good estimate, a nice swag, if you want to call it that, to where our break-even point is at expiration on this particular option. So that's what we're looking for. We're looking for it to be break new highs on May 3rd. We want to see it come up to 100. That would be our ultimate wonderful goal. And then the ultimate golden ratio would be 130.9.